Let me share my screen here. Let's get going because we have got lots and lots of important things to talk about here today. Why don't you go ahead and hit that Q&A box and let me know that you can hear me? I would appreciate it. David, David, Justin. All right, friends. Big day today. Jan, big day today. Big day today. Today we're going to talk about how market makers trades. Julia. Um, Before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. Now, allow me to introduce myself to those of you who are not yet part of the Firstrade / market taker familia. My name is Dan Passarelli, and I am an author of 3 of the most popular option trading books. In fact, I'm going to tell you a little bit more about one in a second. Which is ranked number 4 on the Amazon bestseller list for option books. I'm just saying. I am here because I've been a trader for a long, long time and a professional trader for a long, long time. And then I left the trading floor. I left being a professional trader and became a retail trader. I trade in a retail account just like you. And I am the founder and president and chief strategy officer of Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of great people in the trading industry, great brokerage firms and exchanges, brokerage firms like Firstrade, for example. And I'm a family man. Got my wife, Kathleen, my 2 adult children, my little troublemaking dog. I don't know where she is right now. But I had a dream. My dog sleeps in bed with us. She weighs 6 pounds. She's a Morkie, which is part Maltese, part Yorkshire Terrier. You can hear her right now because that's what she loves to do is bark. And she sleeps in what I call the knee nook, where I'll be sleeping on my side and I got one leg, my leg is like bent, right? And she sleeps right behind my knee in the knee nook. And I was having a dream last night that there was a spider and I had to step on the spider. And so I brought my leg up and smashed the spider. And I did that in real life. And I don't know, don't call PETA on me. I love that little dog, but I startled her quite a bit. Anyway, I also do other things. I'm a runner, foodie. I bike sometimes too. Traveler, been all over, man. And I'm a music person. I know. I think she might have. I woke up while she was in midair. Hey, Harold. Um, okay. So that being said, today is the day, folks. My new book, Build Consistent Wealth with Options, is out today. Today is the first day. And would you believe it? It is actually number 4 on the Amazon bestseller list for options books. And today's the first day it's out. Isn't that pretty crazy? It's also number 6 on the list of analysis and strategy. So yeah, geez Louise. There's been a lot of buzz about it, and I'm just ecstatic that it is finally out and here. And I would love for you to get your hands on it. So you can go to Amazon.com or anywhere you buy books and just search for it. Build Consistent Wealth with Options, or search for me, Dan Passarelli, 2 S's, 2 L's, and then ARE, like the verb R in the middle. Dan, Passarelli. Search for that and get a copy. Let's see if we can get up to number 3 or number 2 by the end of the day. That would be super exciting. Can you, hey, what's up, Daniel? I'll tell you what, the little secret of publishing, Amazon can sell my book for less than I can. If I sold my book for the same amount that Amazon does, I would lose money on it. Yeah. Does that make sense? No, doesn't make any sense at all. But that's how publishing works. So buy it from Amazon. That's where you're going to get the best price. Okay. So that being said, yeah, a little bit. I mean, selling books, you don't make a whole bunch of money. It was really more a work of passion, to tell you the truth. Believe it or not, if you're a big enough nerd like I am, you can be passionate about option strategies. I know it's crazy. It doesn't make any sense, but it's true. But I get a little bit out of it. Not much. You would be shocked and appalled at how little I get from each book I sell. But I put my heart and soul in it, and I think it's really good. I'm very proud of the work that I put into it. Yeah. So, okay, let's talk about the role of market makers here, friends. So, who are market makers? They call it, some people call them dealers these days too. Market makers make what? What do they make? Markets, right? And for any option you might trade, there's more than one market maker trading it. And they're competing with each other. Like if you're going to buy 100 shares of Apple or buy 5 Apple calls, it's not that big of a deal. You're not going to impact the market. But with market makers, they're trying to get a piece of every single trade that happens, the biggest piece they can. In fact, every market maker would love to have a monopoly, right? Isn't that what all businesses kind of strive for? And then if they get one, they win the game, and the Justice Department breaks them up into smaller, or not Justice Department, Justice Department breaks them up into smaller pieces, and then they, start all over to become another monopoly. But market makers would love to try and be the only person you could buy or sell a certain type of option to, but it never works out that way. There's always competition, and competition is good for who? You, the consumer. Competition is always good for the consumer because you get tighter bid-ask spreads and you get more innovation. You get greater accommodation to customers of the exchanges. We'll talk about all this a little bit more. And you're able to get more concessions for trades that you make on the exchanges. So let's break this down, talk about how your order is filled. So with options, we have something called fungibility. You don't get to use that word every day. You don't get to even hear that word every day. What does fungibility mean? It means you have to see the dermatologist, right? No, it means that they are interchangeable. So if I buy one May 15th Apple 270 call on the CBOE, I can go and sell it on the NASDAQ. because they're all fungible. They're all the interchangeable. And so that means that market makers on the CBOE are actually competing against market makers on the NASDAQ. And there's like 18 different exchanges nowadays. So competition is pretty fierce. That's one of the reasons why the bid-ask spreads are very tight these days. Now, you hear people refer to options as contracts. I just said that right there, a standard contract size. Every option represents, well, for the most part, every option represents the rights on how many shares? How many shares? Who can tell me? Let's see who's going to win. Boom, Jan. 100 shares, right? Because they're all standardized. You know, they all basically work the same. Now they're called contracts. And if you like buy a call and you end up exercising your rights to buy the stock, which is what the call gives you the right to do, you're going to buy it from who? From the other side of the contract, a person who's short the call. What if that person says, oh, hey, you know, man, sorry. I ain't got any money and I ain't got the shares, so I'm not going to sell them to you. Sorry. Oh, it's your right. Well, sue me. Like that could happen in a regular type of contract, but not this kind because they're all guaranteed. They're backed by clearing firms, including and especially the central clearing firm, the Options Clearing Corporation. And options, because they're standard, they make them, that is something that makes them more liquid. If they were all, you know, bespoke, one represents 100 shares, another one represents 80 shares. One expires at noon, the other one expires at 9 a.m. There'd be no liquidity. But standardization leads to fungibility, which leads to liquidity. What do I mean by liquidity? Liquidity is the ease at which an asset can be traded without affecting its price. So if you go into like, I don't know, the flea market. When's the last time you've been to a flea market? Who's been to a flea market within the last 6 months? I haven't been to a flea market. Well, actually, I was in a flea market about within the last 4 years. Anybody else been to a flea market within the past year, 2 or 3? No? All right. Well, I guess that means you're normal. But, you know, you go and like imagine somebody selling all these things, you know. They made knit caps. And every time they open up their booth, they sell out in the first hour. Yeah, books. Right. They sell out in the first hour. And then they come in the next day and they sell out in the first hour. They come the next day and they sell out in the first hour. What is the first thought that that person is going to have if they have half a brain? I got to raise my prices. Right? Or the other way. They open their booth in the morning and no people come by, they look at it, they say, how much is it? And they walk away. And that happens every day. They don't sell anything for 3 weeks. Well, you got to lower your prices. There's not enough demand. We're all subject to supply and demand. Yeah, right. Yeah, maybe your hats are ugly, right? But, you know, it works that way when it comes to options as well. There are some times when there's so much trading in an option that somebody can come in and buy 200 calls at, at 85 cents where they're offered, and they're still offered at 85 cents. But there's some stock option classes that are just not very liquid, and somebody can come in and buy 50 at 85 cents, and next thing you know, it's offered at 90 cents. Oh, yeah, we don't want to sell you anymore. Well, that's supply and demand. And, when it comes to making markets in options, and, spoiler alert, I was a market maker in options. Like I know how this game is played. When it comes to being a market maker and making markets and options, if there's a lot of like the way you make your money is by buying the bid and selling the offer. We'll talk a lot more about that in a minute. But if like the way it works is somebody comes in once a week and buys 100 calls, and then next week they come back and maybe they'll buy more or maybe they'll sell them. That's tough business. It's tough business. Like restaurants. Nobody comes in that much. They don't have turnover. They got to throw all the food away. It's, they lose money. Can't run a business if there's not enough commerce. So that affects liquidity. What market makers do is, well, another thing, liquidity is dispersed among the strikes. I mean, even in spiders, SPY or apple, like the spider from my dream. There's not an apple in my dream, just a spider. Ask my little dog. If somebody just decided I'm just going to make a market in the June 690 calls, they're not going to be able to make enough money because on any given day, I mean, Goldman Sachs might come in and buy 1,000 of them, and that's the trade of the day. So what they need to do is they need to spread their risk. And by doing so, making markets in all the options for a certain stock, they end up providing liquidity. I love teaching this because you know why? A, it's not something you think about every day. And B, it's actually much more important than you think. Much more important than you think. If you understand how market makers trade and what you're competing against them for, I personally believe you can be much more successful. So market makers are people or firms, for that matter, that quote bids and offers in options. They verbally announce it in open outcry, and there are still trading pits. The CBOE has trading pits in Chicago. I've been there many, many times. In fact, when we do masterminds, where we just get a small gathering of 3 to 5 of our most ambitious traders, we have the class at the CBOE and we go down and check out the trading floor. Still a lot of action there. But most trading, though, is still done electronically. But it still all works the same way. Market makers have privileges and obligations. Their privileges are they have direct access to the exchange. They don't need a broker. The reason why the rest of the world needs a broker is because the exchange can't have every individual in the world just connecting to their exchange. That would be a disaster because people would have questions, people would have silly questions. They're not professionals yet. They're still learning. There would be so many wires coming into it. It would be a disaster. So the exchanges allow access to certain people, and those people pay a lot of money for that. When I was a market maker and had direct access to the trading floor, I mean, I know I was paying sometimes $14,000 a month. Believe it or not, it's true. $14,000 a month. I think about that now and I'm like, golly. But you don't pay that because you trade through the broker, Firstrade. They pay their membership fee to have a permit to trade with direct access, and they represent you by because they have direct access. They represent your trades, and that's why you pay them a very, 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 very small commission, or a typical broker anyway. And market makers have favorable margin requirements. You might be familiar with retail portfolio margining. Market makers margining is even more liberal. But along with great power comes great responsibility. We all saw the first Spider-Man, the good one. Now there's like 57 million Spider-Mans and they all clash with each other. And it's just like, I mean, is anybody still into superhero movies? Aren't there just too many? I mean, don't get me wrong, like I'm a red-blooded American male here. I like superhero movies, but it's just too much. It's just too much. Too much. But yeah, with privileges come obligations. Sometimes you have to give a quote. Now, you might be sort of surprised by that. Like, why wouldn't the market maker want to trade? But, there are sometimes in a fast market when things are just going crazy, that the market makers get scared to trade, honestly, because they don't want to get run over because they have to hedge and they might miss their hedge. And market makers need certain capital requirements. Somebody just asked me about how much capital to start with. I mean, that's tricky because, when I started on the trading floor, I had a backer and they put $30,000 in my trading account, which sounds like not a lot of money, and it's not. But here's the thing. I had a line of credit, basically. If I had to buy shares of, companies that I traded to hedge my option position, I mean, $30,000 is not going to cover it. So, I would be trading on margin upon margin upon margin. But I have to have a certain amount deposited with the clearing firm. And, my backer had that. So that was a little easier for me. So market makers provide liquidity, which is a service. And I know, don't hurt your eyeball rolling it too much. But, and I've had people tell me, like, I've got this friend. He's a friend of a friend, but he's actually a friend too. And he's a contractor. And he does the work himself too. He like contracts, but he also swings a hammer. And he's a gruff South Side Chicago guy. And we were chatting one day and he's like, well, yeah, but you don't create anything. And I was like, wow. He's kind of, he's a really nice guy. I love the guy, but he rubs most people the wrong way. And I was like, actually, I do create something as a market maker. I create liquidity. And he's like, oh yeah, okay. Keep telling yourself that. But it's actually really, really true. If you're trying to buy the bid, sell the offer, and all the market makers went away, there'd be no bids or offers. The only bids or offers that would be there are the other retail or institutional traders. And those could be tens of dollars away from where you want to trade it. Without market makers providing liquidity, the market would literally just fall apart. It's true. So let me ask you a question. You ready? Are you ready? What is the market maker's objective then? It's to provide liquidity, right? No, that's an accidental byproduct of their objective. Their objective is to make money, to trade for profit. But in doing so, they end up creating liquidity. The profit objective is the bid-ask spread. Market makers say, this is my bid, this is where I'll buy it, this is my offer, this is where I'll sell it. Go ahead, buy it from me, sell it to me, I don't care. They create liquidity by taking the other side of orders that come to the exchange. So this is literally how market makers make money. And we'll look at spiders here. $4.57 is the bid. $4.60 is the ask or the offer. How did this bid get there? Does Firstrade just make up a bunch of prices and throw them there? No. There's literally a market maker, probably sitting in a chair somewhere in an office or wherever, and they program their computer. You know, they have a third-party software or whatever app to say, I am $4.57 bid. So then who's $4.60 offer? It's got to be somebody else, right? No, it's probably the same person. So are they bullish or bearish? No, neither. It's not a question that makes sense. They just want to buy the bid, sell the offer, and do that all day long and lock in pennies. They make very small profits, but the more they trade, the more they make. They make many, many, many transactions. Brokers execute orders electronically. They display hundreds of thousands of bid-ask quotes automatically that come from the market makers. The market makers are sitting in their office making these markets, disseminating them out to the exchange, and then the exchange sends them to Firstrade. And you see those bids and offers that come from the market makers. Firstrade just does you that service to let you see it. And then you make the decision, because you're a self-directed trader, of what you want to do. And then electronically you buy or sell or announce a new order by maybe middling the market. Can they trade their own offers? No, you can't trade your own offer. How are you going to do that? You're going to sell it and buy it from yourself at the same time? I mean, sure, but it only exists in your brain. Like, I'm going to sell this can of Red Bull to myself at $1 million. I'm going to get rich by selling it at $1 million. What kind of sucker would buy it from me at $1 million? Why, I'll do it. I'll pay $1 million for that can. Okay, deal. How do you shake hands with yourself? Okay, deal's over. I just sold this for $1 million and bought it for $1 million from myself. Case closed. Oh, I know what I said, Daniel. Listen very closely. Listen closely. I'm talking about important stuff. So Christian says less liquidity equals more profit for the market makers. Now, there's an interesting thought there. So yes and no. Actually, probably not. You would think it would be, because less liquidity means wider bid ask spreads, right? Which is great. I would love them to be wide. But here's the thing. If there's a lot of trading in there and I keep my markets wide, well, other market makers are going to see all that volume and they're going to come in and they're going to say, oh, well, Dan's this wide. I'm going to step in front of him, offer lower and bid higher. And now Dan doesn't get any trades. And then Dan, me, says, wait a minute, now I'm not making any money anymore. I'm going to offer lower than him and bid higher than him. Now I'm getting all the business. And so the more business there is, it forces the markets together. And then you trade a lot more with lower profits. But when you're able to have your markets wide, it's only because nobody is really trading it. You probably don't have a ton of competition, but it doesn't matter. Like, there are some stocks that trade like, 10 contracts a day in all of their options altogether. So those are the less liquid ones. It's interesting, right? Yeah. So Dan, just to be clear, market makers bid 457 and offer 460, and they just wait. They just wait. Like, you ever go to the grocery store and there's like, a sign in the window that says like boneless ribeyes, only $5.99 a pound today? It's an advertisement. They're telling you how much they'll sell it for. Well, that's what 460 is. They're saying, I'll sell it for 460. They're also saying, I'll buy it for 457. They bid and wait, and they offer and wait. So, back to the grocery store, but let's just say the grocery store is not a grocery store. It is a flea market. I'll sell these, knit hats at $4.60. But I also buy knit hats. If you want to sell them to me, I'll buy them for $4.57. So I'm not necessarily trading. I'm telling you, this is what I'll sell them for. This is what I'll buy them for. You see this, like, gold is a lot higher than, had a great run last year. You might see a gold dealer in a mini mall somewhere near your house. They might have that sign in the window. Hey, we buy gold at this price. We sell gold at this slightly higher price. That's an advertisement. That's what bid and asks are. They're market makers' advertisements. Okay. Is there a limit on how many market makers an exchange has or can have? How does that impact liquidity? Yeah, great question. So, there is a limit to the number of permits allowed on each exchange. Whether the person holding the permit is a broker or a market maker, because those are the only two types of traders that there are, that's determined by, the invisible hand. Remember, you guys ever learn about Adam Smith when you were in school? You probably had to be an economics major or something like that. But they call it the invisible hand. It's just like when there's not enough market makers, that means that the market makers that are there start making a lot more money. And then there's going to be more market makers because they're like, holy crap, look at how much these market makers are making. Yeah, I'm going to switch teams. I'm going to become a market maker. So, yeah, they call that the invisible hand of economics, where, it's just sort of like supply and demand or whatever, just like logic makes people make decisions and that balances out prices. I kind of did a lousy job explaining that, but I think you got the gist, I hope. I put in a buy at 448 and get covered. Yeah, you can bid below the market. We'll talk about that. All right. So sending orders to the exchange electronically. So, you'll log into your Firstrade account and click on the offer to buy and click what type you want, a limit order, market order, good till cancel, put in all that stuff, the price if it's a limit order or a stop order, and you send it. You just click send. And then those electrons go from your computer to Firstrade's server to the exchange server. And then it gets matched up with one of the market maker's bids. If you're trying to sell it, was it 457 and there's a market maker 457 bid, it gets matched up and it's executed. The trade is made. If you offer at like 459 and they're 457 bid, then you probably are not going to have a trade immediately, or maybe not at all. And you will see the offer go from 460 to 459 because you'll see your own order on the screen. You can actually provide liquidity too. Now, there's something called the best bidder offer. All market makers generated bids or offers are all sort of like confluenced through this system called OPRA, OPRA, from all the market makers on all the exchanges, all go through this same pipe. And all the resting orders too. Your order, if you put in a mid-market order, or like somebody who just said, oh, I'll bid below the market, that's sitting there in the background. You don't see that unless you have like, the order book or something. And then Oprah sends them all out to the brokers as an aggregated bid and offer, and they're displayed on your Firstrade platform. So like the best bid in the offer is the highest bid or offer anywhere in the world. This is the highest. There might be a market maker's 280 bid, but this one's 285 bid. It might be a market maker's offered at 305, but there's somebody offered lower, 295. The highest bid and the lowest ask is the market. The market is 285 bid at 295. If you offer 290, now the market is 285 bid at 290. You are part of the market. Okay. So market makers may make large individual trades and thus accumulate large overall positions. And when I say they make a trade, here's what market makers don't do. They don't do what you do or what I do. They're in a whole different ballgame. When I was a market maker, I never looked at a chart of the stocks that I traded, not once. There are a couple stocks I didn't even know what companies did. I was one of the top traders in my pit. It didn't matter what they did. I didn't have to be an expert at their company because I would trade direction neutral. I would delta hedge. What I had to be an expert in was the volatility of the options on that stock. That was what I was an expert in, and where to set my bids and offers. What the company did, whether it was going to go up or down, I didn't know. I didn't care. Didn't matter. No expertise there. So market makers spread risk, and the biggest risk for any option trade is always delta. No, it's not true. It's not always delta, but it's usually delta. So that one's easy to fix. As soon as I make a trade, I buy or sell enough shares to offset the delta of my options. Now, all I have is the option-centric risk, theta, gamma, implied volatility, or vega. Then I have to hedge those off. If I bought options, I've got to sell options. If I sold options, I've got to buy options. So I got to really understand the Greeks. That's why my first book was Trading Option Greeks. But the new one that's out today, don't forget, I would be honored if you pick it up. And I think you will be very happy that you did. I spent a lot of time on Build Consistent Wealth with Options. I'm already getting some really amazing feedback. I mean, geez Louise, it was just out today and it's already number 4 in the bestsellers. Oh my goodness. It's ahead of like some pretty notable and impressive authors out there who are super smart people like Sheldon Napenberg and such. But anyway, you got to know the Greeks. I'm going to give you a crash course. Delta, rate of change of an option relative to a change in the underlying. Stock goes up or down. How much do I make or lose on my option? That's delta. And that's why I can hedge it with shares of the stock. Gamma is the rate of change of delta relative to a change in the underlying. Theta is the rate of change of an option relative to a change in time. As time passes, options get worth less. How much less? Look at the theta, and then you will know. Vega is the rate of change of an option relative to a change in implied volatility. Implied volatility is this sort of esoteric. Let's talk about implied volatility. When it comes to options, there's 2 types of volatility. Realized and implied. Now, realized volatility, which is also called historical volatility or statistical volatility, is the annualized standard deviation, really, of daily returns of a stock. That you just need a handheld calculator and stock prices from the last month, and you figure it out. Implied volatility, that one's the one that's a little bit more esoteric. Textbook definition is the volatility figure that when entered into an options pricing model yields a theoretical value reflecting current market prices. What the hell does that mean, right? Well, what it means is when there's a lot of demand, people come in and they buy a bunch of options. Well, that pushes the price higher, right? That's how the world works. When there's a lot of supply, people selling a lot of options, that pushes the price down. That is what implied volatility measures. Never lose sight of that. You will hear people tell you a lot of other things about implied volatility, but never lose sight of what I just said. So then there's a lot of spreading that goes on as a market maker. Having a position a spread is having a position consisting of 2 or more options that partially or completely offset one another. So maybe I'm long 5 March 60 calls and short 5 March 65 calls. That's a spread, right? Does anyone know what kind of spread that's called? Debit call spread, right? Or bull call spread. Long 7 September 80 calls, short 7 June 80 calls. What kind of spread is that? Time spread, right? Long time spread. Short 10 April 20 puts, short 1,000 shares of stock. Oh, that's a weird one, right? Some people call that covered puts, but there ain't nothing covered about it. Long 25 August 70 puts, short 50 August 65 puts. Ratio diagonal. Like you end up with a lot of weird stuff when you're a market maker because you're not acting, you're reacting. You're taking the other side of orders that come in, not deciding what orders to take. You're deciding what price and how many you'll accept at each price but that's the only thing you get to decide. Delta hedging spreads off the largest risk and most immediate risk. Definition of delta hedging is hedging or neutralizing the delta of an option position. Now, this is capital intensive. Remember when I said I started with a $30,000 account? Well, I mean, granted, I got that account a lot higher over time, but even in the beginning, I mean, there were times where I was long or even short several $1 million of the stocks that I traded options on. And I never had a directional bet on. They were all hedges. And so I was trading in a very leveraged way. Market makers typically delta hedge all of their option trades. So here's an example of delta hedging. Let's say I buy 20 40 strike calls that are at the money. So that's long 100 deltas, right? If they're 50 delta each and I have 20 of them, 20 times 50 is 1,000. How do I delta hedge that? Well, I sell short 1,000 shares. Now my position, my delta is flat. Or maybe I've bought 50 75 strike puts that have a 40 delta. And 40 times 50, that means I'm short 2,000 deltas worth. How do I hedge that? I buy 2,000 shares at whatever the price is, right? So I'm short 2,000 deltas, long 2,000 deltas. Another thing here. Maybe I buy 20 of the 40 strike calls with a 50 delta and I sell short 1,000 shares at 40. So, okay, I'm delta hedged on this flat delta, but not flat the other options risk. I still have gamma because I'm long options. I still have theta because I'm long options, and I still have vega because I'm long options. So that means if the stock moves up or down too much, my delta changes and I've got to rehedge. And it means as time passes, I lose money. And it means as implied volatility changes, I make or lose money. Long options always have positive gamma, negative theta, positive vega. Short options have negative gamma, positive theta, negative vega. All right. The way to think about this is gamma and theta are always opposites because theta is what you pay for positive gamma or what you receive for the problem of negative gamma. And gamma and vega are both the volatility ones, so they both have the same sign, both positive or both negative. Okay, spreading off non-delta options risk. So as soon as I buy or sell an option, the first thing I do is hedge delta. Now, if I'm overall long options, I still have time decay working against me and I have volatility risk. If volatility goes down, I lose. So I have to sell some options to hedge that. If I'm overall short options, I need to buy them. Because if I'm overall short options, I have negative gamma that can be a problem. I have, if the market moves too much, I lose with negative gamma. If the market, if the volatility goes up, implied volatility goes up, I lose if I'm short options. So I've got to buy options to hedge that. Oh my gosh, there's a lot going on here, isn't there? I forgot what this was like being a market maker with all this info. This is how market makers reduce risk. They prefer to close open contracts. So here, let's look at this. Let's say I'm a market maker and I program my computer to say I'm 155 bid and I'll sell it at 161. And then somebody, Daniel here comes in. Daniel's long this stock. And so he wants to sell calls to do a pretty close to the money covered call. Daniel sells these to me. Daniel's a shooter, so he sells me, a 10 lot. He's long 1,000 shares of Google. What's $300,000 among friends. So sells me 10 of these. What's the first thing I do as a market maker? I sell short Google stock to hedge off the delta. But I don't really want to do that, right? Because then I have the other risk. If Daniel sells me 10 of these at 155, you know what I really want to do? I want to sell them at 161. I want to sell my offer. But who am I going to sell my offer to? Nobody. I mean, the only way I sell my offer is if a human being somewhere, whether they manually make the decision to do it or have programmed their decision or program their computer to do it. The only way I'm selling those at 161 is if someone else in the world decides to buy them from me at 161. There's nobody in the world who is willing to buy them at 161 right now. And you can see that because the highest bid in the world is 155, which happens to be my bid too. So I want to sell the offer, but I can't. So I get stuck flat delta because I delta hedge, but I still have gamma, theta, and vega. And so I can strive to get flat them and hedge off the gamma, theta, and vega by trading close proxies as offsets. Not perfectly fungible, but close. So what was that trade? It was me buying the 307 and a half calls at $1.55. So I could, sell some other calls or buy some other calls or buy some puts. If I buy some options, I've got to sell some other options to hedge the gamma, theta, vega. So the way market makers really think about it, because they are only saddled with gamma, theta, or vega risk, they're only thinking about the Greeks. They're thinking, hey, I'm long volatility or I'm short volatility. That's all they think about. And volatility is gamma and theta is your realized volatility. Vega is your historical volatility. Joe says, considering the high volume a market maker deals with, how do they track where they need to take action? Great question. So, yeah, I mean, imagine a market maker who's trading something that has weeklies, not even something like Apple where there's Monday, Wednesday, Friday expirations, but just weeklies. I mean, there could be 18 expirations or something. I don't know. I never really sat down to think about it. I mean, at least 15 expirations of both calls and puts, and there could be 20 strikes in each expiration. No human can track all that. Nobody. Even if you have a computer, being able to make sense of it and remember it when an order comes in, just to be like, am I long these or short these? I don't know. I've got like 500 option positions just in this stock. So the only way that they can do it is to massively simplify it by just turning everything into the Greeks. Okay. I'm long 52 of these, short 6 of those, long 3,217 of those, short 562 of those. Doesn't matter. What's my position delta? What's my position gamma, theta, and vega? Oh, okay. I have negative theta. Oh, okay. That means I'm long options. So I need to sell some. Okay. Maybe I'm going to lower my offer a little bit. They lower their offer, and then that, that's like the sign in the window. Boneless ribeyes, just $5.99 today. Hey, you know what? I really got to dump these. They're going to go bad. $4.99 today. Still make money, or at least break even. So that is how they do it. That is exactly how they do it. All right, friends, we're going to wrap up today. But remember, today is the day. If you have not picked up Build Consistent Wealth with Options yet, please do. I am trying to get this to number one in the bestsellers in option trading. I'm sitting at number 4, which is, it is pretty impressive, but I want to get to number 1, and you can help me. This is a good community. You guys show up every week. We help each other. Buy it, but don't buy it exclusively for me. Buy it for yourself. If you trade the wheel, covered calls, or cash secured puts, I promise you're going to be really, really happy about this. I put everything I know into it and the kitchen sink. All right. That said, friends, I will catch you next week. Have a great rest of your day. Trade smart, and I will see you next time. Bye.